Melly everybody, I'm Cantonese Cat. Hey everybody, Cantonese Cat. I wanted to do a quick reaction video to Tom Lee. I love Tom Lee. Going to talk about what he's kind of thinking about what the market is going to go, where it's going to do over the next couple of weeks. We do have the FOMC meeting on Tuesday and Wednesday, and I think usually around 2 o'clock on Wednesday, Jerome Powell will start talking about, their rate cut decision. There's going to be a rate cut. Question is going to be 25 points, 50 points. I'm here to tell you that I don't think none of that really matters, but I'm going to basically just play and see what Tom Lee has to say because I like this guy.
Tom Lee. Tom, the small caps that I know you're watching closely had a good day, but I mean, is it September or is it not September, right? We had a rough start, and now some of that's in the rearview mirror.
Yeah, I mean, I think if viewers are sort of confused, I think that's what the next 8 weeks are going to be like into Election Day. I think it's a very challenging period because no one can have conviction until they really know who's in the White House. But
I have conviction, but that's just me. Honestly, Tom Lee's been really talking up small caps here for a while. This is IWM. This is a monthly chart IWM, which is the Russell 2000. It really is the smallest cap. Smallest cap index, if you will. And it is very economically sensitive. So far, we've gone through several cycles. I would say that this is, ever since the Great Financial Crisis, we've gone through cycle like number 1, 2, 3, and 4, right? And pretty much every single time when a cycle happens, you're going to have a period of time for anywhere from like 6 to 12 months where you're going to have like a sideways accumulation zone over here. And during from 2018 to 2020, you have a longer period of time because of COVID, which was really a true black swan event, right? And then also since 2022, we've really had like about 18 months of accumulation zone sideways. So I'm extremely bullish when it comes to small cap. If I had to come up with all the indicators here, which I've talked about previously, I think one indicator you can do is look at Bollinger Band. And I like to look at the 20-month moving average. This is the orange line over here. Whenever it kind of went from flat to positive, usually things kind of run up for a while. Whenever things went from flat to positive, usually things kind of ran up for a while. Whenever things went flat or slightly negative and went up positive, usually things ran up for a while, right? We're starting to have this like negative sloping and turn positive sloping. So I think that there is maybe a chance that we might be at like an early mid area of this bull cycle here for small cap. I think it's going to run, quite substantially. I had reacted to a video by Tom Lee back in July. He was basically just saying, oh yeah, don't be surprised if we just go up from like 20-30% in the month of August. I was bullish on small cap, but I was also holding my skepticism because we're simply just way outside the upper Bollinger Band. I just don't think that it's going to go up like 20%. I think it's going to wait for the Bollinger Band to expand to allow price to go up higher. That's exactly what it's doing right now. In August, we have this really big macro fear where there's a lot of price just kind of shot all the way down over here. And it didn't even get close to the 20-month moving average. 20 moving average is still pointing up, right? So the whole like Yen carry trade turned out to be more or less of a nothing burger so far. And I think it's probably going to be a nothing burger overall. That's one way to look at. The other way to look at it is, you can look at Ichimoku cloud. Whenever price over the last few cycles, whenever it just kind of touched the cloud and bounced, it tends to go on for about 2 to 3 years. Touch the cloud and bounce, tend to go on for about 2 to 3 years. Over here, COVID did overshot that all the way through the cloud, but it went back up and touched the cloud, and then it went up for another like year and a half, right? And then so far for 2022, it just went to the bottom of the cloud, bounced, went to the top of the cloud, bounced, and right now we're above the cloud, right? So usually this kind of above the cloud, maybe more or less like a beginning of a longer term, maybe like 18 months or something like that in terms of where it's going to go, right? Another thing too, there's the red and blue line over here. There's this Tenkan line, which is the blue line. You have the Kijun, which is the red line. Whenever they have a bullish cross, whenever the blue crosses over the red, you basically have a bullish cross. And usually when you have a bullish cross, things tend to go on for quite some time. And the Tenkan, the blue line, tends to be serving as support on the way up, right? Here you have a bullish cross over here around 2020, around November. Here you have a bullish cross over here around October 2016, and things just kind of went up for a while. Here you have a bullish cross over here around June of 2012. It ended up going up for another like 3 years, right? So I think that at this point, we just had to cross, and it's just starting to kind of expand. The thing just started kind of expand away from the kitchen. it's like, I think we're like right around here, right? And I think we're maybe like right around here. So I think small caps are probably going to run on for a very long time. I can keep going on and on about why I think that. I also think that small cap is going to do relatively better than IWM moving forward. The reason why I say that, if you look at Russell 2000 over small SPX, really the last 10, 15 years has been underperforming, but it's not always going to be the case, right? If I pull up the RSI, I've talked about this before. I'm sorry about repeating myself to some of my viewers, but I think it's important to talk about these concepts. Small cap actually, after the dot-com bubble, has drastically outperformed the S&P 500 large caps, all the way up to around like 2011. And it's interesting because like the dot-com bubble really have bursted some of the large cap companies, whereas the great financial crisis, I guess, is when the small caps, which include a lot like financial and housing stocks, that's when they really started to get crushed, and they never really recovered in relation to S&P 500. S&P 500 has been very monstrously outperforming small cap for a very long time, really for like the last decade and a half. But I think the trend may be changing, because over here, when you had the outperformance of small cap over S&P 500, this was happening on the monthly here on bearish divergence, where it just kind of went up with this Russell 2000 over S&P 500 ratio. And you're on bearish divergence, which means that this uptrend where Russell 2000 outperforming S&P 500 was going to, most likely it's going to end. And it did, and it kept on going for like about a decade and a half, right? So far, what I'm seeing is really a bullish divergence. So I'm actually seeing a very, very similar thing over here, except opposite. I think that there's a possibility where small caps are going to probably end up outperforming S&P 500 in the upcoming years. And that's kind of what I'm seeing. And I just want to highlight that this is a bearish divergence and this is a bullish divergence. Bearish divergence went down for a decade and a half. Bullish divergence, potential for S&P 500 to underperform IWM or Russell 2000, potentially for small caps to start outperforming large caps, right? So that's kind of what Tom Lee was talking about. I'm going to keep letting him talk here.
There are some positive sort of supports coming into play, and next week is the Fed meeting. We know the Fed is going to make some cuts, and with the inflation data being supportive and the labor markets needing some support, I think it's going to give the markets some confidence. So I think we do kind of trade well into that meeting and maybe even the week or two after.
Does the market?
It's hard to time these short-term things. It really is hard to time these short-term things. All I have to say is whenever, and Tom Lee is great, but all these analysts on CNBC, they're all talking about what the Fed's going to do, what Jerome Powell's going to do. It's going to be 25 points, it's going to be 50 points. I'm going to tell you, I don't care, because the federal, the effective federal funds rate, you can pull that up on the chart here on TradingView. It really has been stuck around 5.33%. It really hasn't changed at all, right? Does that really reflect what the real market is doing? Does it really reflect the amount of liquidity that's in the system? Does it really reflect what the lenders and the borrowers and the debtors are actually have to pay or receive in terms of rates? The answer is no. Like, this does not tell you anything about what's going on in the economy. It does not really tell you anything about anything, because there are these real rates that you can actually chart, such as the 2-year and the 10-year yield. All these yields are really based on, I'm going to make this a linear scale here. All these yields are based on real market conditions, based on bond demands and things like that. And really, all of these, the 2-year and 10-year yield, they already peaked around 5% in October 2023. The market has already done the rate cut for them, where you already have the 10-year and the 2-year already went from like 5.2, 5.3, all the way down to about 3.6. This has been drastically decompressed, and as a result, even like if you look at mortgage rates, let's see, like if you look at the 30-year fixed rate, it's basically showing you that, because your real rates have declined, even the 30-year mortgage rate has already declined all the way from like 7.8% all the way down to 6.2%. So you already have increase in liquidity. You already have easing in terms of borrowing here. I mean, like, is this as slow as how it was over here previously? No. But even just a few years ago, the rate was like 4.8%, So right now, 6.2%. Actually, it's not anything drastically crazy. I think the biggest thing is more from like 2.6% all the way to like 7.8%. I think everybody was just really freaking out. But now that you have a little bit of a downtrend, and now that you actually people are starting to get used to high mortgage rates, and now you're having decreasing mortgage rates, I think this is going to be pretty positive for the market. And even though people are worried about the Fed is not cutting yet, the real market is already doing it for them. And it looks like it could probably keep going down further, to be honest. I feel that you look at a Bollinger Band, like rates wants to plummet further, but the lower Bollinger Band here on the monthly is really preventing them from doing that, right? Like it's as support, like that it wants to drop further, but it's as support, so it couldn't. That's kind of how I'm looking at it. So I don't really care what the Fed does, 25 points, 50 points. I really, really don't think it matters because the market is doing the job for you. I'm going to go back to IWM here for a second. I'm going to pull up something else here, which is this global liquidity index that I've had look at. So let's see. This is called the M2 Global Liquidity Index here. And I'm going to pull up even a little bit of a weekly chart to give you a little bit more data. The line down here is the conglomerate of the M2 money supply from the US, China, Japan, Europe, and the Great Britain. And you can see that pretty much IWM has been following this chart like really, really closely, right? Every single time while you have kind of price kind of breaking out above that area, especially over here, whenever you have price kind of break above, generally is also associated with a breaking above of the increasing global liquidity, especially this cycle. Like if you just kind of zoom into this cycle, I really think that we're kind of breaking above something here. How do you get rid of this? Maybe I get rid of my magnet. Let me see. Yeah, so whenever you have this breakout line over here, sorry, I can't get rid of it for now. I'll figure out later. When you have a breakout over here is when things might start to run. And I think that right now we're at a potential area where if you continue to have increasing global liquidity that has already broken out of this trend line that's been going on for about 2.5 years, then you might be talking about potentially, not necessarily a parabolic move like that, but I think you're potentially having like more sustainable move like that. You see like increasing global liquidity, right? Increasing in IWM, increasing in global liquidity, increasing in IWM, right? So I think that eventually this price is going to catch up to the global liquidity, to the real rates. Whether or not whatever the Fed does really doesn't matter to me, but let's just keep listening.
Market need a 50 basis point cut to stay within that 5,300 to 5,700 range that you think we're going to bounce around in?
I think that a 25 or 50 has both hawkish or dovish implications.
Right.
So I think it's ultimately whether Fed Chair Powell comes across as this is the start of a cycle where they're confident that we're moving back towards neutral. And what
the chair, the Fed Chair Jerome Powell has already given a pretty dovish talk during Jackson Hole. I think even before that, you can see the writing was on the wall that they're going to cut the real market conditions already cut for them. And I don't know. Whenever somebody says if something happened, it could either be good or either be bad. That's the problem with listening to narratives. I think it's good to actually have like real data to chart, which is actually part of the reason why I chart, because you actually know what the price action is. You kind of know what the whales they're doing behind the scene, and you don't have to guess. You don't have to base on a narrative and then figure out whether or not it's bullish or hawkish. It's actually better actually look at price action and look at where things are going to be. That's just my philosophy, but again, Tom Lee is a lot smarter than I am, so I'm just going to keep listening.
Whatever number they make is actually quite dovish and positive. But if it seems like this is dragging along the FOMC members, and then there's even concerns about a hard landing, then I think the market can view anything they do as negative. I think it's going to come out positive, though. But
to me, hard landing means that banks fail. To me, hard landing means that banks fail. We already had banks failing in like 2023. And as a result, the real rate has already dropped, which is kind of my way to think that the market has already kind of corrected itself. It has already deleveraged both in terms of stock market. NASDAQ dropped 40%. Bonds, TLT, a lot of people were over leveraged on bonds for a very, very long time. That got significantly deleveraged, right? So you're talking about the consumer stocks like Nike, things like that, even like Celsius. Like you're getting some significantly deleveraged going on here. I think overall it's actually pretty healthy for the market. But anyway, let's just keep listening.
I mean, it seems like the Fed chatter would be in that direction. They didn't want people to get too excited about too much in terms of rate cuts. But now that they're there, it seems like they're signaling that they're kind of on a path.
Yes, that's right. But, from a market's perspective, I think that they'd like to see the Fed sort of acknowledge that inflation is moving back as a secondary concern, and supporting labor markets while not in a recession is incredibly important. So I think that you're right. There's a chance that this could all be interpreted negatively if the Fed seems really reluctant to cut.
What do you think about inflation? What are your thoughts on inflation? There are a couple of things you can look at inflation, and I've talked about a lot of this before. First of all is the U.S. oil. I was pretty bearish on oil overall, and the whole idea as to why I was bearish on oil is because of technicals. It just looks like it's doing a little bit of a dead Cantonese bounce. Whenever you have a look like this, usually things don't look good, right? What's the most famous example for something like that, where you have a little bit of bouncy balls and the thing just kind of fall under, and it's going to be Bitcoin, right? Everything goes back to Bitcoin. They had the same look around here, where you have a big giant bouncy ball, and eventually you fall off the floor. This is what oil is really, doing to me currently. It's just that it looks like it's just having a big giant bounce and smaller bounce. It looks like it wants to bounce through the floor. I don't want it to bounce through the floor, but could it go down potentially to like 60 or even potentially lower? I think it's entirely possible. The reason why I say that is just the technicals kind of support, to not be that bullish on oil. Just looking at the bull in Japan here, it's touching a low bull in Japan. Again, it could be supported, it could go up, but so far the 20-month moving average is currently down. Like, nothing is telling you that the oil chart is strong. And all of those crazy people that have talked up oil, like from like late 2022 to through 2023, especially when we start having like all these international conflicts that have been going on, they're talking up oil. I don't know what they're talking about. Like, just looking at technicals, that's the problem with narratives. You have these Middle East crises. You have like Russia, Ukraine. You're thinking of spike up oil. No, it doesn't. Like, that's not what's being reflected here on the economy. Just look at the chart, right? The other one that generally people look at in terms of inflation, you can look at commodities, which is GSG. GSG also had that same look where it's got like a little bit of a dead Cantonese bounce to it. It doesn't look as bearish as oil. So far, you do have a little bit of like a hammer bottom can over here. And so far, the 20-month moving average is flat. I don't want GSG to plummet. I just want it to kind of stay where it is. And if it goes down a little bit, that's fine. If it goes up a little bit, that's fine. That doesn't really bother me one way or another. But the inflation that you're worried about, where GSG went all the way from like 7.5 all the way to like 26, that's over. Like, that is over. That's no longer here. Right now, if anything, I think we're kind of getting to more normalized level as we were over the last, throughout the whole like beginning part of this decade or so. Right now is actually not anything like drastically crazy or anything like that, which is what the market wants. They want stability, right? Anyway.
Most people ought to be investors, not traders. So are we up against, whether we're talking about the Fed or even about the election, a potential narrative shift in the markets, or no?
I think in the near term, we're losing visibility. And, when you don't have visibility, people get scared and they sit on their hands. But over the next 12 months, I think investors should be pretty confident. When the Fed has cut rates while in a soft landing or no landing, the win ratio or markets higher 6 months, 9 months, 12 months later is almost 100%. And we also know post-election markets almost always rally. So the November, December looks pretty good. And I think the policies of both candidates is good enough for markets to do well next year. So I think we might have turbulence now, but it looks pretty good after that.
Now, back to that turbulence for people who are...
Don't be surprised that the S&P 500 and the QQQ doesn't do anything too crazy over the next, let's say, a few months or so. and you have stocks that are more risk on, like IWM or even like the ARK funds, don't be surprised if those really start to make a comeback during this period of time. The reason why I say that is I just want to go kind of like talk about the NVIDIA chart here. You remember there was a period of time where there was a lot of people that were very, very crazy about the market because they just kept going up in a straight line. You remember there was a period where between, I would say, maybe around like, July, August, all the way to maybe March and April or so, where Bitcoin was going up significantly. You have all of these like Bitcoin miners, all these small cap stocks, all of these like high debt stocks, Zoom, all kinds of stuff. It was just going up like crazy nonstop, right? This is the monthly chart for NVIDIA during that period of time from August 2020 all the way to like March or April 2021. What did NVIDIA do? Absolutely nothing. It did nothing for like 7 or 8 months, right? What did NVIDIA do so far over the last 4 months? Absolutely nothing. Like, did absolutely nothing, right? To kind of give you an idea, I'm going to basically just pull this up here, and I'm going to put the IWM during the same period of time from like, August to April, right? What did IWM do? It beasted up like crazy. Like, it didn't want to stop. It just went up, right? And that's the period of time when August 2020 to April 2021, when NVIDIA did absolutely nothing, right? So far, again, what did I say about currently? NVIDIA has done nothing ever since June of 2024, right? Again, NVIDIA has done nothing during June 2024. And for IWM, what has it done so far? It basically has just shot up and it kind of backtested a lot of these levels down here below. I think this area over here is very similar to this area over here. And I think I'm not sure we're going to end up getting this crazy candle because there was a lot of money that's being put over here. I'm not sure, but I think that this might be a little bit more sustained move. Maybe you also get a little bit of a more bullish candle over here, or maybe you're going to get a little bit more like a gap up over here to kind of break above the all-time high zone. But so far, I just see a lot of correlate between where we are right now versus potentially kind of where we were from like, August to April 2020, 2021. That's kind of how I look at it. But anyway, let's just go and listen to Tom Lee here.
Trading. It's been a weird September because usually when the month starts bad, it's bad. But we have this situation. How do you read it?
Well, yeah, you're right. If you took the 10 worst first week of September, it's like the 10 times the September was down 2.5% or more. 10 out of 10 times the market never finished positive.
For the month.
For the month. In fact, if you took the 20 worst first weeks of September, 20 out of 20, September was a down month. So, however, 3 out of 10 times from the 5th day, which would have been Monday, to the end of the month, you actually clawed back gains. You just didn't finish the month positive. So I think it's a strange seasonal. I might just say, to me, next week is more important because it's the Fed and the put coming into play, and that might be the dominant factor for the rest of the month, and that could be quite a support for markets.
So let's talk about some broader issues, particularly mega caps versus small caps. We saw a big comeback for NVIDIA. We saw really some continued flexing strength from the likes of Apple, which is now, I would say, firmly on top in the market cap race, such as it is. And then we've seen small caps struggle more than some might have hoped. Today is an exception.
I don't know what they're talking about because just look at like what IWM has done over the last few months, and then also look at what the QQQ has done over the last few months. QQQ did nothing since June of 2024, and IWM actually went up by a whole lot, through June of 2024. So I think it's kind of funny sometimes to listen to these people talk about all this stuff that doesn't really reflect what we're seeing over the last few months. And I don't know what they're talking about.
Which is more influential in this market?
They're both important, and they reflect different, investor views. I think you still always want to own the best companies in the most important themes. I mean, that's NVIDIA and that's Apple. And they're going to really work over any cycle. But when the market begins to believe the Fed is going to move rates back towards neutral, and that's both cost of money, mortgages, auto loan rates, these are really big tailwinds for cyclical stocks and small caps in particular. So I think that's why I'd still want to make a very educated bet with high probability that small caps could do very well the next 12 months, and even between now and year end.
Bam, you got it. I actually agree pretty much completely with what Tom Lee is saying, with the exception, sorry, you get to see what I normally watch now on my channel. But yeah, anyway, I just want to thank you for listening. What he's really saying is this. What he's really saying is that the seasonality for September is tricky. And it could very well turn out that maybe September still end up being not a very positive month. I'm not sure if I believe that necessarily, because I think that a lot of the deleveraging has already happened in August. So I'm not sure if I necessarily believe in that. But what he's really saying is like, yeah, September seasonality, be cautious over the last couple of weeks. And that's also what my friend Jess has also been saying too. And a lot of these seasonality things have been playing out pretty well throughout the year. But what I think about the market, I'm not that scared if it goes down further. To me, because all of this is still seem to be relatively, even for a QQQ, if I just use the Ishimoku here, it's just right as support at the rising Tenkan. Like there's nothing really too bearish. Like it just looks like, on a bull market, it rises, it bounces off the Tenkan, it goes higher. So I'm not really worried about this particular look over here. I think it's probably going to end up having some pretty decent bullish continuation. But what he's saying is, yeah, be an investor, not a trader, if that's the kind of thing that you want to be. None of this is financial advice, but I think it's pretty cool to listen to what Tommy has to say and then kind of like chime in without him even knowing. So anyway, thank you so much for listening. Have a good one. Bye.